Pankaj Murarka is with us, CEO and Chief Investment Officer at Renaissance Investment Managers. Pankaj, of course, is a long-term bottom-up stock picker. I don't know how much geopolitics is clouding his mind. Having known him for a while, I don't think it is, in a very large way at least. Pankaj, how are you thinking about the whole situation? I mean, actually, markets around the world, equity markets especially, are largely unbothered with what's happening. Even markets in that region are unbothered. How would you look at where we are, and what are the dominant drivers according to you from here?
Morning, Prashant. I think, Prashant, on this conflict over the weekend and the US strikes, I think markets are largely drawing an inference that this escalation will remain one contained within the region, so largely in Middle East, and probably there will not be a spillover to the rest of the world. And a large part of my understanding is a large part of transmission of this crisis, if we call it one, is going to be essentially through one, higher energy prices. And we've already seen oil prices up by almost 20% from $65 to $78 or so. So they're probably pricing a risk premium for this crisis. And secondly, probably through lower risk appetite. But I don't think so that the lower risk appetite, as far as the risk assets is concerned, is setting in globally, because the underlying economic growth momentum in across US and some of the Asian economies, or I would say global economy, remains fairly strong. So investors probably are taking a belief that probably this crisis will remain contained. They still believe the escalations will not go too far in terms of Iran exercising some extreme options, and probably a short-lived one. And to that extent, the larger part of transmission is through energy prices, which has some impact on India. But I think India can still deal with it, given our strong external balances. Overall, on the economy, I think one thing clearly that stands out when you talk now, how do you think going forward from here? I think India is in a situation where we are very extremely resilient as an economy. And I would like to draw your attention. The finance minister had written a piece in one of the business newspapers a week back, where she highlighted that all the 5 balance sheets of India are very strong, which essentially is government of India's macroeconomic fundamentals are very strong. The external balances with our forex cover and import covers are very, very resilient. Corporate balance sheets and bank balance sheet in India are very strong. I'm seeing such healthy corporate and bank balance sheets in India almost after a gap of 20 years at the same time, which effectively means there is significant capacity on part of corporates to invest and on part of banks to lend. And finally, the household balance sheet, your and my balance sheets are extremely strong in terms of ability to spend. So combination of all of this means that in an environment globally which is extremely challenged, probably India comes across as one of the most resilient economy with very stable growth. And I think that is what driving markets at this point of time, I think so. And I think that is what really sets India apart from a lot of other economies in the world which have their own set of challenges. So sum total, the view on markets still remains positive. I still think that Nifty index can do a low teens kind of a CAGR returns from here over the next 1 year, over the medium term, over the next 3 years. And probably it's someone like us, or for investors who have a medium term perspective, it makes eminent sense to remain extremely bottom up focused and focused on picking right stocks and probably not letting some of these macro headwinds and news flow overplay on your investment decision or portfolios.
Hi Pankaj, good morning. Good to see you in. So you're sounding reasonably optimistic actually on prospects within India, which is good news as well. It appears that things should work in our favor. Earnings should be better. Earnings growth should be better. And actually our markets have been quite resilient, going by all the cues we've seen in the first half of the year. I think you briefly alluded to last time around, you're expecting consumption to pick up. And you're actually taking a contra bet. I think you were quite positive on staples. Tell us more. Does that call hold on?
Yeah, Nigel, morning. Yeah, absolutely. That does hold on. I've been saying that at a $4 trillion economy that India is now, and 60% of this economy drives its growth from consumption, so which effectively means our aggregate private final consumption expenditure by itself is the 8th largest economy in the world at $2.4 trillion. Companies which can execute well can derive significant growth out of this ecosystem. So I clearly think that one, as it is, I think there'll be we're coming out of the long-term growth, last 15 years growth of our aggregate consumption is about 11%. Last 2 years, the growth has been about 6.5%. So one, I firmly believe all the stars are aligned for a cyclical recovery in India's consumption sector or a consumption basket or final aggregate consumption expenditure by households in the second half of this year and building into the next year. So we are in for a very healthy cyclical recovery. And more importantly, companies which are executing well and strategizing and executing well can grow at a much higher rate. So yeah, my whole hypothesis on that is one space where I find, valuations have now normalized from where they were far in excess or pretty expensive at the time of COVID. Last 5 years, consumption or consumer as a sector, companies in that sector, by and large, underperformed big time as versus the broader market indices, and also earnings growth has been lagging. I think we will now valuations have normalized and earnings growth will accelerate. So probably I think next year, consumer sectors will actually grow higher than the aggregate index earnings growth. So I certainly think that one can comfortably make mid-teens to high-teens kind of returns in some of the consumer names, and with the kind of safety and security they offer in terms of downside protection, both to earnings and valuations, I think for low risk investors like ourselves looking at medium term high teens kind of returns, at this point of time, that sector looks very attractive.
Okay, consumer. You'll look out for that. Point noted, Pankaj. Also, by the way, I'm looking at some of the early movers and keep a watch on some of the defense names because they've already started gaining some ground. Not all, but a little bit. Garden Reach Shipbuilders, for instance, some of the private sector names like Paras Defense I had seen earlier, even Idea Forge. Some green on these stocks while the overall market is a little subdued this morning. Pankaj, so yeah, what about this space? The news flow refuses to die down when it's defense. But the question is, I mean, whether it's too late from a stock point of view to be an investor now. What's your sense?
Absolutely. I think it's very clear that stocks have done phenomenally well, given that now there's a new defense doctrine that India has had with our own challenges with which we faced with our neighbor a few weeks back. It's a given that India's defense spends are going to increase significantly, and probably for all companies in the space, the opportunity is very significant. Yet I consider that the valuations in the space are extremely rich. Any defense company now trades at multiples, which it's difficult to justify this defense companies now basis near-term earnings multiple over the next 2 or 3 years. So clearly, markets are pricing in a sustained high growth in terms of earnings and cash flows for these defense companies over a very long period of time. I think some of these companies will deliver, but it's very obvious that when these kind of things happen in a particular sector, and we have seen time and again repeatedly in history of market, that many of these companies will not live up to the expectation. So I think it's very important for investors to make choices between the stocks very carefully. At this point of time, because a lot of this is driven by macro narrative, it's very difficult to figure out which companies will be able to execute well and deliver, and which will not be able to. From a value-oriented investors like ourselves, we have taken this opportunity to actually take money out of defense stocks. So, and it's very difficult for us to own stocks where we cannot justify them on the near-term valuations over the next 3 years or 4 years. So I think anyone being invested into those stocks from a more fundamental perspective will have to look at earnings and cash flows over much longer time horizons. Stock price behavior is more a function of momentum, and momentum. Investing into momentum in stock price is always very risky because momentums can fade. They can come very quickly, but they can also fade equally quickly. And the stock price swings on either sides can be very, very sharp. So I would urge that investors should really think through in terms of what they're expecting from these stocks from a longer term perspective. And as I said, from a value investor like ourselves, we are actually sold into our holdings. So we do have very little exposure to defense at this point of time.
Yeah, no, absolutely. And we've heard that, earlier as well. The tailwind is there, the spending thrust, etc. is there, but markets price everything so quickly, and maybe a lot is already priced here as far as the entire defense space is concerned. Pankaj, any new areas of interest to you where a lot of new sectors, right? Many are actually in the unlisted domain though, but new industries developing, segments, etc. coming about.
I still continue to feel pretty excited about, internet companies in India, because I still think a lot of these companies are growing at a pretty healthy or high rate, if I may say so. So slightly more, the point is, Prashant, we are dealing with the most expensive equity market in the world. And we are in the 6th year of this bull market. So it's a very matured bull market. In a matured bull market, in the most expensive equity market in the world, it's difficult to find value on the table. So obviously, one way of playing it is one can go down the curve, which effectively means you end up compromising portfolio quality and buying poor quality companies. My experience of doing that way back 20 years back has been very bad, and I've burnt my fingers very badly. So I'm extremely cautious of not committing that error. And then the other way of playing around in these markets is you take a slightly more longer term horizon in terms of where you can find earning surprises, or where growth is underpriced in that sense, while keeping the quality of business and quality of management intact, kind of a thing. And one space where I still find that growth can surprise positively is the internet sector or India's internet ecosystem, because I think their growth, meaning while their markets are pricing in growth, I still think in the medium term, long term, given India's growth dynamics, growth can surprise there positively, or can be much higher than what market are pricing in. And my experience of investing into high growth businesses has been, as analysts, we tend to overestimate growth in the short term, but we do end up underestimating growth in the long term, where we underestimate India's long term growth potential and growth trajectory for many of these companies. So if you go back to a lot of these companies which are large, probably when we forecasted growth for these companies 20 years back, we did underestimate their long term growth potential. So I find a lot of those opportunities in internet sector, and from our point of view, we're trying to focus more on slightly more longer term, while not going down the quality curve.
Sure. Okay. All right. Point well taken, Pankaj. Thank you very much for being with us this morning and for giving us all of that perspective. Good speaking with you today.